Welcome back to Talk Tickers, where we strip the fluff from the transcripts and get straight to the numbers that actually move the needle. I'm your host, and today we are breaking down the Q4 2025 print from the absolute giant of the tool world, Stanley Black Decker. The ticker is SWK.
And this was a fascinating one. If you were watching the tape yesterday, February 4th, you saw just a masterclass in market psychology.
Oh, yeah.
It was a chart that looked like a heart attack and recovery, all in a single session.
Exactly. We're calling this the classic two-speed print. If you look at the top line, the revenue, the car is sputtering, it's, stalling out. But if you look at the bottom line, the profits.
Oh, it's racing.
It is racing. We have a revenue miss, an earnings beat, and probably the most aggressive strategic pivot away from China manufacturing we've seen from an industrial major this cycle.
It's a really complex quarter, but the market reaction tells you everything you need to know about what investors value right now. It's a story of execution triumphing over a pretty difficult environment.
So let's get right into the tape. This was a wild ride. The press release hits, and the stock immediately drops, about 2.4% in the pre-market?
Yep, the algorithms saw that revenue miss and just hit sell. Looked like it was going to be a rough day.
A total knee-jerk reaction. But then the market digests the call, the opening bell rings, and the buyers just stepped in. By the close, SWK rips higher, finishing up 4.53% at $84.63.
Huge reversal.
So, okay, let's unpack this. Why did investors panic? And then why did they change their minds so aggressively?
Well, it comes down to the difference between selling stuff and making money. And yes, those are two very different skills.
Right.
The headline numbers paint that picture perfectly. Adjusted EPS earnings per share came in at $1.41. The street was looking for $1.28.
So that's a near 10% beat. That's significant.
It's a huge beat, but the revenue.
The revenue is the ugly part.
It was $3.68 billion. The estimate was closer to $3.77 billion, and that's down 1% year over year. So they sold less stuff than expected.
So sales are down, but profits are way up. That brings us to the star metric of the day, the one number that I think saved this stock and caused that reversal.
The gross margin. This is where the magic happened. Adjusted gross margin hit 33.3%.
And that's up a massive 210 basis points year over year.
Right. And just to clarify for everyone, 100 basis points is 1%. So they improved their profit margin on everything they sell by over 2% in 1 year.
Which is huge for an industrial company. When you're moving steel and plastic around the world, that's incredibly hard to do. It means for every drill they sold, they kept a significantly larger chunk of cash.
Speaking of cash, let's look at the cash flow, because that's really the lifeblood of any turnaround story.
It was a monster quarter for cash.
An absolute monster. They generated $883 million in free cash flow just in Q4. For the full year, they hit $688 million, which beat their own internal plan of $600 million.
So they beat their own cash target by almost $90 million.
Exactly. So to answer your question, why did the stock reverse? Because in a choppy economy, investors will pay a premium for execution and cash generation, even if growth is hard to come by. It's all about the quality of earnings.
It's the difference between empty calories and a nutritious meal. They proved they can squeeze more profit out of every dollar of sales, even if those sales aren't growing.
Precisely.
So let's go deeper on that. How exactly did they expand margins by over 200 basis points when volume was actually down? Usually when you sell less, your factories get less efficient and margins get crushed.
Yeah, that's operating leverage in reverse. But this wasn't magic. It was just extreme discipline. Management cited three specific drivers: higher pricing, aggressive tariff mitigation, and the big one, their global cost reduction program. They hit $2.1 billion in run rate savings.
$2.1 billion. That is not finding loose change in the couch cushions. That is structural change.
Oh, it is. And here's where it gets really interesting for the long-term thesis. They aren't stopping at 33%. They explicitly stated on the call that they are targeting gross margins above 35% by Q4 of 2026.
That's a very bold target given the environment.
It is, but if they hit that, it shows immense operating leverage. The business is basically a coiled spring now. Their cost base is so lean that if volume ever does come back...
If the housing market picks up.
Right. If people start buying tools again, their profits are going to explode because the expenses stay flat while revenue climbs.
But we have to talk about the elephant in the room, or maybe the elephant in the shipping container. Tariffs.
The tariff situation is the biggest macro headwind they face. It's what every industrial analyst is trying to model right now.
And they addressed it head on. I was surprised by how specific they got. Usually companies are vague, saying we're monitoring the situation. SWK gave us hard numbers.
They were very specific. They are aggressively moving their supply chains out of China. Management said that by the end of 2026, so less than a year from now, they expect North American sales sourced from China to be less than 5%.
Less than 5%. That is essentially an exit.
It is. I mean, remember, just 5 or 10 years ago, the tool industry was synonymous with Chinese manufacturing. This is a massive logistical undertaking.
And they're moving it to USMCA zones, right? Mexico, the US, Canada.
Exactly, and they're ahead of schedule. This is crucial because it insulates them from the volatility of trans-Pacific trade wars. While competitors are scrambling, Stanley Black Decker is just leaving the blast zone.
I love that phrase, leaving the blast zone. But let's play devil's advocate here. You can cut costs and move factories, but eventually you have to sell a drill to someone.
And that is where the picture gets messy.
Right, the demand dynamics. While the operations team is crushing it, the sales team is fighting a headwind. Volume was down 7% in Q4.
That's a big number. 7% fewer units moved.
And the reason is price elasticity.
Exactly. They raised prices to offset inflation and tariffs. And the consumer blinked. Specifically, management noted weakness at opening price points.
The entry-level stuff. The basic Black & Decker drill you buy for a small apartment project.
Right. The DIYer who needs a tool for one specific task is looking at that price tag and saying, you know what, maybe I'll just borrow my neighbor's, or they're waiting for a promotion.
So the breakdown was pretty stark. The tools and outdoor segment was down 2% year over year. Power tools specifically were down 8% organically. That's your core DeWalt and Craftsman user pulling back.
But, and this connects to the broader industrial picture, engineered fastening was a bright spot, up 6% year over year.
Engineered fastening. Sounds boring, but tell us why it matters.
This is the high-tech stuff that holds airplanes and cars together. This segment was driven by aerospace, which saw a massive growth, up 35%.
35%. That is incredible.
It is. And auto OEMs were up too. So the professional industrial side of the economy is still humming. Boeing, Airbus, Ford, they are buying. It's the consumer at Home Depot who's feeling the pinch.
A tale of two economies inside one company.
Exactly.
Okay, so we've got a mixed demand picture, but stellar execution. Now, I want to pivot to the strategy because they dropped two massive pieces of news. First, let's talk about an AM.
Consolidated Aerospace Manufacturing. They announced a definitive agreement to sell it for $1.8 billion in cash.
Now, wait a minute. You just said aerospace is the only part of the business that is growing 5%. Why on earth would you sell the golden goose?
That's the question, isn't it? On the surface, it looks crazy. Hey, this is our best growing asset, let's sell it.
Right.
But you have to look at the balance sheet. $1.8 billion is a lot of dry powder. And they aren't using it to go on a shopping spree.
They're paying down debt.
Precisely. Their number one priority is deleveraging. They want to get their leverage ratio, their debt relative to their earnings, at or below 2.5 times EBITDA.
Which puts them firmly in that investment grade safety zone.
Exactly. In a high interest rate world, paying down debt is a guaranteed return. It cleans up the balance sheet, lowers their interest payments, and gives them flexibility later. But right now, cash is king and debt is the enemy.
So they're sacrificing growth in aerospace to buy safety for the whole ship.
That's a great way to put it. It's a very conservative, mature move.
Now, the second strategic move is one I found fascinating. They are exiting the manufacturing of gas-powered walk-behind mowers.
This is a classic addition by subtraction move.
Explain that, because on paper, they're losing revenue.
They are. It creates a, $120 to $140 million revenue headwind in 2026. Sales that just disappear. But think about a gas mower. You have steel, engines, oil, complex assembly. The margins are razor thin.
And the market is shrinking anyway. Everything's going electric.
Exactly.
Yeah.
So instead of building them and dealing with the headaches, they're moving to a licensing model. They just license the brand name to someone else, let them build it, and SWK collects a fee.
So revenue goes down, but margins go way up.
Significantly, because a licensing fee is basically 100% profit. They're dumping a low-margin, shrinking product to focus on their core electrification strategy. A very smart move.
I love that. It shows they aren't chasing empty calorie revenue.
Exactly. And Wall Street loves nutritious revenue.
So what does this all mean for 2026? They gave us guidance, and honestly, it was a little soft.
It was. For the full year 2026, adjusted EPS guidance is $4.90 to $5.70. The midpoint is $5.30.
And the street was at, what, $5.66. So they guided down effectively.
They did.
And yet the stock went up. This is the paradox. Why does the stock go up on a weak guide?
It's the under-promise, over-deliver setup. The market looked at that guy and said, okay, you're being conservative. Management warned that Q1 is going to be messy.
Right.
They said peak tariff expenses will hit the P&L in Q1 and Q2 before all that mitigation we talked about fully kicks in. They expect Q1 margins to be flat year over year.
So the expansion is all in the back half of the year?
Right. So investors are looking past the messy Q1 and betting on the exit velocity in Q3 and Q4. They believe the margin story is real, so they're willing to forgive a conservative guide. Their betting management is sandbagging a bit.
Plus, they are still investing. I noticed they mentioned increasing SG&A by $75 to $100 million.
Which is critical. That money is going to innovation and marketing for DeWalt and Craftsman. You can't starve the brands. DeWalt is carrying the team. It grew low single digits in a down market.
That's brand power.
It is. Even when people aren't buying tools, if they do buy one, they're buying DeWalt. You have to keep feeding that beast.
It really is a story of a company getting its house in order. They've accepted the reality of a low-volume market and structured the business to win anyway.
That's the hallmark of a mature, well-run industrial. You can't control the macro, but you can control your costs, your supply chain, and your margins. And SWK is controlling the controllables better than almost anyone right now.
So we've stripped the fluff, we've looked at the numbers, now it is time for our favorite segment. The part where we throw caution to the wind and pitch a trade idea that is absolutely, positively...
Not financial advice.
This is not financial advice segment.
Huh?
We're going to pitch a wild trade idea based on the data. I call this trade the deleveraging slingshot.
Ooh, I like the name. It sounds dangerous. What's the setup?
Okay, here's the thesis. SWK is selling TAM for $1.8 billion. That cash is going straight to debt. They're exiting low-margin gas mowers. They're moving supply chains out of China faster than anyone.
So the risk profile of the company is dropping rapidly.
Exactly. But the market is pricing them like a cyclical industrial with a heavy debt load. My argument is that by the end of 2026, they are going to look like a lean, mean, cash-generating machine with low leverage.
And when that risk profile changes, the multiple expands. Investors will pay a higher PE ratio for a safer company.
Exactly. You get a re-rating. So here's the trade. You don't just buy the stock. You go long, LPDES long-term equity anticipation securities.
So options contracts that expire in more than a year.
Right. You buy call options that expire in, say, January 2027 or 2028. You want time for the company to pay down that debt and for the tariff mitigation to really hit the bottom line.
You're leveraging the leverage reduction. That's interesting.
Yes. But you need a hedge because Q1 is going to be messy, right? The tariff jolt.
It could get ugly for the whole sector in Q1.
Right. So you pair the long SWK LPS with a short position on a competitor, and I won't name names, but you look for the tool companies that haven't moved their supply chain out of China yet.
The ones who are going to eat that tariff cost in Q1 without a real mitigation plan.
Precisely. The tariff pain SWK is feeling in Q1 is going to crush anyone who isn't mitigating. So you're long the execution, short the supply chain laziness. It's a capital structure play masquerading as a tools trade.
That is aggressive. And I have to point out, if the consumer completely falls off a cliff, if housing crashes, nobody is buying drills. Both sides of that trade could get hurt.
Oh, absolutely. High risk. If unemployment spikes, this trade is dead. It's an outrageous idea for the brave. But if the thesis holds, that slingshot effect when the debt clears could be massive.
It's a fascinating way to play the balance sheet restructuring. It's betting that management does exactly what they said they would do.
So to wrap this up, SWK delivered a messy top line, but a beautiful bottom line. The market hated it for about an hour and then loved it.
The market rewarded execution over growth, period. The key for 2026 is navigating that tariff jolt in Q1. If they can get through the first half of the year with margins holding steady, the back half looks very strong.
And keep your eye on that 35% gross margin target. If they hit that by year end, this stock is in a different league.
Absolutely. It changes the valuation entirely.
That's it for this deep dive into Stanley Black Decker, a story of self-help in a tough neighborhood. Thanks for listening to Talk Tickers. Do your own diligence, and we'll see you on the next sprint.
See you next time.